Welcome back to another edition of Intelligent Investment Today, the podcast concerned about all things value investment. In each episode, we consider a different subject to see if the value investment framework, as laid down by value investment's founding father, the late great Benjamin Graham, can shed light on problems faced in today's markets. In this episode, we consider the lessons we can take away from one of the stock market's most famous bubbles of recent times. I'm talking of the dot-com bubble of the late 1990s that finally went pop in the year 2000. We'll discuss how technology-inspired bubbles are nothing new and why we are likely to be on the verge of yet another one in the form of the technology surrounding artificial intelligence. So sit back, strap in and get ready for another dose of intelligent investment, as inspired by Benjamin Graham himself. Many listeners will need no introduction to the dot-com bubble of the late 1990s, but to some younger listeners it may feel like something that happened in another era. For me, it was to prove my personal baptism of fire into the world of equity investment, occurring as it did at a point in time when I was in my late teens and at a point where I was beginning to invest serious money into the stock market. At this point I was still young, naive and very green, and yet to discover Benjamin Graham. It would in fact prove to be the main catalyst why I sought out someone like Graham, having lost a lot of money speculating on tech stocks. The bursting of the dot-com bubble would go on to be the most important lesson in investment I would ever receive, and I was lucky in many ways that it came so early on in my investment career. It was a very expensive lesson in the risks of speculation, and I vowed never to make the same mistake again. So what exactly happened to teach me this very valuable lesson in the dangers of speculative activities? In the late 1990s, it became pretty obvious to everybody that this new thing called the internet was going to become huge. The direction of travel was one way, and the investment community knew it was about to completely rip up the old way of working. The issue was that whilst it was obvious to everybody that the internet was going to change everything, nobody knew at this point exactly how things would pan out, and which of the tech stocks on the scene would be the winners and which ones would be the losers. Even with businesses that could not seemingly fail to profit from the changing circumstances, like Microsoft or Oracle, things were not clear-cut, as nobody could agree where the final destination of this internet thing would be. And placing a valuation on an unknown future is a notoriously difficult game. We had been here before, of course. We saw similar bubbles inspired by sudden changes in technology, transforming the economic outlook at the time, from the railroad bubble in the 1840s, automobiles in the early 20th century, radio in the 1920s, transistor electronics in the 1950s, as well as home computers and biotech in the 1980s. All these bubbles have the same thing in common as with the dot-com surge, with investors suddenly realising that there was an opportunity to back the big winners of a new economy. The issue was, whilst everybody can guess the general direction of travel, nobody can precisely say how things will pan out. And for every business that was set to reap the rewards, there would be many more with seemingly equally promising outlooks that would fall by the wayside. In the auto boom, for instance, for every Cadillac or Ford, you had hundreds of other businesses like Crawford Automobile and the Cunningham Car Company, to name just two, that wouldn't make the grade. Only the investor armed with a fully functioning crystal ball would have been able to determine that it would be the likes of Ford and Cadillac that would go on to become the winners of the new technological landscape, rather than the other upstarts. This was the exact same problem faced by investors in other tech booms, including the dot-com boom. It is easy to say with hindsight that it was always obvious that the business behind Google would go on to be one of the first trillion-dollar companies, but back in the late 90s, AltaVista, Excite, Lycos, Ask Jeeves and others seemed equally well armed to dominate the nascent market for internet search traffic. In the dot-com boom, like all the other tech booms before it, the assumption was that an obvious change in the way things were done would be a rising tide that lifts all boats. The history of how these things pan out in reality was again forgotten about, and that reality is that a handful of businesses will go on to be the big benefactors, whilst the vast majority will fall by the wayside, wiping out their early investors along the way. The issue is that it is normally far from clear in the early days of a boom which businesses hold the competitive advantages, or indeed what competitive advantages are required to enable them to go on to dominate their market. And of course, all the normal frailties of human behaviour come to the fore at this point of a tech bubble. The fear of missing out, the jealousies aroused by seeing others making three-digit returns in a matter of weeks, with the investor increasingly becoming detached from the reality of the situation. It becomes almost irrelevant at this point whether a business will go on to succeed. All that is needed is for someone else to be prepared to pay more than they did. The greater fool theory of investment in a nutshell. Between 1995 and the peak of the dot-com bubble in March 2000, the Nasdaq stock index rose by an astonishing 800%, only for it to give up 78% of its gains by October 2002, leaving the index roughly back where it started from 7 years previously. Many of the businesses that seemed the most promising just a couple of years before, like Pets.com and Boo.com, failed completely and shut up shop, exactly as we saw with some of the most promising railroad companies, automobile and home computing businesses in previous tech booms. In short, the dot-com bubble, whilst dramatic, was nothing we hadn't seen before, and it's something we will see again in the future. We will see it again because human nature doesn't alter, and recall is painfully short. This begs the serious question, are we already inside the latest tech bubble? Once again, we have a new technology on the scene that is about to change the world as we know it. We are talking of artificial intelligence. Every investor knows that this new technology is going to alter quite dramatically how we do things in 20 years' time. Just as investors knew in the early 20th century the automobile was about to change things, as was the internet in the late 1990s. Once again, we don't know exactly how things will pan out with AI. This makes it awfully difficult to determine which companies have genuinely useful competitive advantages. So like with trying to determine who, out of Google, AltaVista, Lycos and the others, would triumph and which would fail, investors, or should I say speculators, are left to place their bets. The Nasdaq index has roughly doubled over the course of the last few years or so, which is a large rise in itself, but still far off the 800% we saw from the same index during the dot-com years. It would seem clear that while some valuations are what you might call fruity, we are not yet seeing the sort of speculative excess we saw back then. There could be some reasons why the market is being held back from the wild speculations we've seen during previous booms. For one thing, interest rates continue to be high, something that was not the case in the late 1990s. And something that is bound to affect the attractiveness of stock market investment in general. The other theory that I have is stock market investment now has increased competition as a destination for the wildest forms of speculation. I'm talking about cryptocurrency markets that were not an option for speculators back in the 90s. Whilst the total capitalisation of crypto markets is still relatively small as compared to the total capitalisation of an index like the Nasdaq, I ask myself whether crypto markets are becoming a greater lure and distraction to those who would formerly have been looking to the stock market to exercise their speculative peccadillos. So in short, I feel we're not there yet, even if many businesses in the game seem overpriced, certainly from a value perspective. What could change to alter that picture? Lower interest rates, like we saw during the last bubble, is certainly one thing. Cheaper money would need to find a home somewhere, and of course, sometimes it only requires an unknown spark for people to suddenly get caught up in a mania. At the point of mania, those human emotions we've already talked about take over, and no price is seemingly too much to pay for a business when there will always be a greater fool willing to take it off your hands for an even higher one. In conclusion, it is not inevitable that the AI revolution will lead to the next tech bubble, but the intelligent investor should always be on high alert to the possibility. History demonstrates there will be another tech bubble at some point, and it will burst. And always remember, bubbles can be the master of disguise and often hide in plain sight. However, those who follow the framework laid down by Benjamin Graham are highly unlikely to get caught out, for all bubbles rely on overpaying for businesses, paying in excess for fruits, real or imagined, of a very uncertain kind. Value investors, on the other hand, following the Graham framework, are loath to pay a penny more than what the financial reality dictates. We are not susceptible to wish thinking and have learned the robustness of character required to prevent our human instincts leading us into a speculative mindset. Stick rigidly with the Graham approach, and value investors can not only avoid the carnage of stock market bubbles, but by displaying patience and waiting for bargains, they can actively profit from them. That is all for today's episode. If you've enjoyed it, you can do the one thing that will ensure you need never miss any future episodes. Hit that add to playlist button. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.